$33.4 billion for AES Corp. I'm telling you, the mega deal is officially back from the dead.
Back from the dead or just temporarily zombified by steady interest rates? GIP and EQT teaming up feels like a massive defensive play, not a victory lap.
Oh, come on. A $33 billion defense? That's a massive flex. Almost as big as Trian swooping in to steal Janus Henderson for $52 a share.
Only because Victory Capital got scared of a little hostile drama and ran away.
The corporate soap opera we deserve? Which one are we tearing apart first? The rundown.
$10.8 billion for Beazly. Zurich is absolutely not messing around this quarter.
They're writing a massive check to own specialty insurance. It makes sense, though. Cyber risk, environmental liability, that's where the premium growth is right now.
Sure, but look at the multiple. They're paying a huge premium for a book of business that gets extremely volatile if global tariffs and new regulatory reforms actually hit next year.
Speaking of regulatory risks, how about Cintas buying UniFirst for $5.5 billion?
The great uniform rental war.
Honestly, I love this deal. It's classic, boring, cash flow generating consolidation. Cintas gets massive economies of scale.
Oh, come on, Nate. You can't actually think this gets past the FTC without a fight.
Why not? It's just industrial laundry.
Just laundry? Put them together and they own a ridiculous share of the market. I pulled the UniFirst footprint data this morning. The geographic overlap in the Midwest alone is massive. Antitrust watchdogs are going to have an absolute field day.
Fair point. I'll take the over on it closing, but you're right about the divestitures. If you want a deal that's pure Hollywood narrative, though, Netflix just bought Interpositive.
Wait, is that the AI filmmaking startup?
Yep, founded by Ben Affleck.
Ben Affleck is selling AI tech to Netflix. What is happening?
The simulation is fully broken, but it proves the point. The urgent need to acquire AI capabilities is creating this massive ripple effect. If you don't have an AI acquisition in your Q1 deck, you're basically invisible.
I genuinely can't wait to read the footnotes on whatever earnout structure Ben Affleck negotiated.
Probably paid out in Netflix stock and Dunkin' gift cards.
That would be completely on brand. But we need to talk about the real corporate drama happening right now. The battle for Janus Henderson is turning into a complete soap opera.
Victory Capital abruptly walking away.
Right. They claimed they only wanted a friendly transaction, which left the big one, $33.4 billion. I honestly had to refresh the terminal 3 times this morning to make sure I wasn't seeing a typo.
It is very real. GIP and EQT are holding hands to take down AES Corp. This is the absolute definition of a mega deal, Maya. The big boys are officially back in the sandbox.
It is a massive flex. But Nate, look at the premium they are paying. They are pricing this like we are back in the zero interest rate fever dreams of 2021. It makes no sense.
I completely disagree. I think they're pricing it like interest rates have finally stabilized, which they have. You have 2 massive funds staring at literal mountains of dry powder. They need scale, and AES gives them incredible scale in the power sector.
Scale, sure. But AES is a legacy utility company trying to pivot. You don't just buy $33 billion of power assets without activists swarming like hornets. The market is barely digesting this valuation, and I am already seeing red flags in the filings.
What kind of flags?
Tariff volatility, for one. Global trade is a mess right now. If supply chain costs for their renewables build-out tick up even 5%, this entire financial model breaks. I read the risk disclosures. They are practically screaming that their future margins are fragile.
You always go straight to the risk disclosures.
Somebody has to. You just look at the shiny press release.
Hey, from a banker perspective, this is a classic club deal. GIP and EQT are teaming up because neither wants to swallow the whole whale alone. It's like splitting a massive, incredibly expensive tomahawk steak at a dinner you're going to expense anyway.
Except the steak might be slightly radioactive, and antitrust regulators are sitting at the next table taking notes.
Okay, fair, but you can't ignore the macro signal here. Global M&A is waking up. Q1 is explosive. You don't write a check for $33 billion unless you have total conviction the macro environment is back on solid ground. Plus, think about the power demand from all these AI data centers. Legacy companies need to bulk up.
Or they just write the check because they are terrified of returning uncalled capital to their LPs.
Wow, the cynicism is running hot today.
I call it realism. I'm telling you, keep an eye on this one. I am expecting serious activist pushback by Friday. Maybe even a counterbid if someone else gets FOMO.
A counterbid on $33.4 billion? Who else even has the balance sheet for that?
Exactly. That's what makes it fun. We will see if the market actually buys this narrative.
Well, speaking of drama and people fighting over assets, we need to talk about the absolute soap opera happening over at Janus Henderson.
Oh, I've been waiting for this all morning. Victory Capital really just took their ball and went home. Voices.
So I was reading this analyst note this morning, and they are claiming this urgent need for legacy companies to buy AI capabilities is creating a massive ripple effect across tech, healthcare, and industrials.
Ripple effect. That is a very polite way of saying blind corporate panic.
I mean, they are not wrong, though. Look at Netflix buying Interpositive.
Ben Affleck's AI filmmaking company. Yes. Because when I think cutting-edge neural networks, my first thought is Goodwill Hunting.
Okay, laugh all you want, but the legacy players are terrified of being left behind. You have to buy the tech if you cannot build it.
I completely disagree. I think half these AI deals are purely defensive PR, so CEOs have something to say on earnings calls. You want to know what the actual smart money is warning about? The second note that went out today, global trade tariff volatility and regulatory reforms. That is the real bottleneck right now.
Spoken like a true skeptic, but dealmakers are pricing all that regulatory risk in.
Are they? Tell that to Cintas. They just dropped $5.5 billion to buy UniFirst. The antitrust watchdogs are going to have an absolute field day with two uniform rental giants merging. You think the bank is priced in a 2-year regulatory root canal?
Fair point. The approval timeframes are getting brutal, but you cannot tell me regulatory fear is stopping the market when we just saw GIP and EQT team up for a $33.4 billion run at AES. Mega deals are back.
They are back, but they are expensive. And with the tariff volatility, those cost synergies they put in the pitch decks are basically fiction.
Only you could look at a $33 billion power play and immediately worry about the tariff footnotes. But speaking of fiction, we need to talk about the absolute soap opera playing out right now over at Janus Henderson. Victory Capital just took their ball and went home. Spill the tea. I am telling you, the Janus Henderson board meetings must look like an episode of Succession right now.
Oh, entirely. But Victory Capital pulling out just because things got slightly hostile? Come on.
They literally packed up their toys and went home. Their PR was amazing. We only want a friendly transaction.
Which in banker speak means our cash and stock offer was weak, and we knew the board was going to laugh us out of the room anyway.
Exactly. And the second Victory blinked, Trian Fund Management and General Catalyst kicked the door down. $52 a share, all cash, sweetened the deal and shut down the circus.
See, this is where I think the market narrative is wrong. Everyone is acting like Trian overpaid to play White Knight. If you look at the amended agreement, they just capitalized on Victory's weak paper. $52 is a steal.
Wait, really? You think 52 all cash is a bargain? They are paying a massive premium for a legacy asset manager. Asset management is a melting ice cube right now.
It is absolutely a bargain. Look at the retention clauses in the footnotes of that amended merger agreement. Try and lock down the key portfolio managers before signing. They aren't buying the brand, Nate. They are buying the yield.
I completely disagree. And General Catalyst usually plays in tech and venture. What are they even doing here? It feels like they got caught up in a bidding war ego trip.
General Catalyst knows exactly what they're doing. They need steady cash flow from legacy companies to fund their massive AI bets.
Speaking of AI bets, did you see Netflix bought Ben Affleck's AI filmmaking startup? Interpositive.
I did. I would pay $52 a share just to see the pitch deck Ben Affleck used on Ted Sarandos.
I guarantee it had zero financial modeling and just pictures of Batman.
Accurate. You know what actually needs some serious regulatory modeling, though? That $5.5 billion uniform rental monopoly Cintas is trying to build.
Oh, the UniFirst buyout. Yes, the antitrust watchdogs are already circling that one. Tomorrow's radar.
I'm keeping my browser refreshed on the antitrust dockets tomorrow for Cintas and UniFirst. $5.5 billion to consolidate the uniform rental market. Regulators are going to tear that apart.
Oh, come on, they're just work shirts. I'm way more focused on the AES fallout. $33.4 billion is a massive valuation, and I guarantee we see an activist file an angry letter tomorrow morning.
You really think someone pushes back? GIP and EQT are paying top dollar. Who has the cash to counter a $33 billion power play?
Activists don't need cash, Maya. They just need a loud microphone and a PowerPoint. Power assets are gold right now.
Fine. You watch the loudmouths, I'll watch the regulatory filings.
Deal, and if we get bored, we can place bets on which legacy company panic buys an AI startup next.
My money is on Friday. See you tomorrow.